Hello, business owners and entrepreneurs. My name's Aaron March, and in this video, we're going to answer the question, what is a trust? Let's go. In order to answer the question, what is a trust? First, you've got to understand, why do they exist? Think back to the ye old England days back in the 1200s. The kings would go off to fight battles, and they might be there for months or even years. When I'm thinking about this, I think about the opening scene of Gladiator. They're off at the battlefield. Marcus Aurelius is there. Commodus is there. Lucilia, even Maximus is there. So who's left back in Rome running the empire? So what they would do is, before the kings would go off to fight the battles, they would need to find somebody that they could trust. Okay, so the king's about to go off to the war, but he needs to find somebody he can trust. So he looks around the lands and he finds Lord Percival. He goes to Lord Percival and says, I've got to go off and fight the battles. What I'm going to do, I'm going to give you the legal authority to deal with all of my properties. So you can enter into contracts, you can hire people, you can do banking, all those sorts of things while I'm away. Importantly, he says, Lord Percival, I'm not gifting you all of my property. I'm just giving you the legal authority to deal with it while I'm away. And to clarify, he says, Lord Percival, any profits that are made while I'm away, you don't receive them in your role. They go to the royal family as beneficiaries of the trust. So what we've got here is a few key points to consider in this scenario. We've got what we call the Appointor. And so that's the king and queen. They get to pick who the trustee is. We've got trust property. And so that's, what is the person looking after for them? So in this example, it's the kingdom. Then we have the position of a trustee. In this example, this is Lord Percival. So he's receiving the trust and the legal authority to deal with the assets on behalf of the king while he's not here. Okay, importantly, as I had mentioned, the king isn't giving him the assets. He's just saying, you can look after these while I'm not here. As I mentioned, if there's any profits or gains from the property that's being looked after, the people who benefit from them are the beneficiaries, which are the royal family. Another important part of it is, before the king goes off and he gives all this trust to Lord Percival, he says, you know what, I'm going to write this down. I actually want to have a whole bunch of rules that you need to follow while I'm not here. I just don't want you doing anything. So I'm going to mark all of these rules down and I'm going to put it into what we're going to call a trust deed. And so what happens there, Lord Percival has to follow the rules of the trust deed. Say, a few months goes past and the king and queen are off and they hear from the battlefields that Lord Percival is not following the rules or he's doing a bad job. What they can do there is that the king and queen have got the ability to hire and fire the trustee. So if Percival's not doing a good job or he's breaking the rules, they can change it. And so they can say, hey, Percival, you're fired, you're out. More likely what's going to happen back in those days, like, Percival, we're chopping off your head. Bam, you're gone. And now that he's gone, we're going to put in Lady Gertrude. So Percival's gone, Lady Gertrude's in, and now she's in the same position. She's looking after the property on behalf of the royal family, following the rules in the trust deed. So that's basically how it works. If I was going to sum it up in a quick sentence, a trust is when somebody says, can you please look after my property for the benefit of somebody else? Now let's have a think about how these different positions apply to a modern day situation. So if we have a think about the appointor, that's probably, it's yourself, you plus your spouse. I always think it's best to have two appointors so that, if either the king or queen or you and your spouse pass away, there's somebody there to take over the role and it's clear about who continues as the appointor. If we think of property in your situation, it might be, a farm or a business, or it could be any asset really. If we think of the trustee, you've got a few options here. You can appoint yourself and your spouse to also be the trustees and actually run the trust for you. What we saw with Percival is that he broke the rules of the trust deed and he actually got hanged. What that means in the modern day equivalent is that if you break the rules of the trust deed, you can get sued. So there's a bit of risk involved there. So often what you do, you put a company in place to run that role. Depending on what type of trust we're talking about, this is, using a family trust example, the beneficiary here is going to be your family. And of course, the trust deed, which is, back in the old days written on a scroll, today I just call that the rule book. And what you need to watch out is that all of these rule books for the trusts, they're all different. They're all customized. So if ever you're dealing with a trust, it's very important that you need to read the deeds. A final part about trusts is that in terms of when they make profit or income, think of it a bit like a bucket, and at 30 June at the end of the financial year, it's got a hole in it, or the bottom falls out and goes. So that income needs to get distributed to the beneficiaries. Now, what happens is each year before 30 June, the trustee will distribute the profits to the beneficiaries. So Gertrude will be sending it to the royal family. Here, you and your spouse, who might be running the trustee company, will distribute it to your family, okay? But importantly, what you need to do is you always need to read the trust deed or the rule book to make sure the people who you distribute the income to are actually allowed to receive it. At 30 June each year, the trustee actually has to write down and sign off on who they're distributing the income to. This is called a trust minute. There are a few different types of trusts. The first one is the discretionary trust. So that means the trustee has got the discretion to pick which beneficiaries receive the income of the trust each year. The beneficiaries, or who receives the income and profits for the year, are fixed, and they're fixed to the unit holders, and the unit holders receive the profits in proportion to the unit holding. So if you own 20% of the units, you get 20% of the profit. It works a little bit like shares in a company. Just a quick word of warning. If you are thinking of running a business in a unit trust, a whole bunch of complex issues that you don't expect can pop up. Division 7A, unpaid beneficial loan entitlements, banks don't understand them, and you can't retain your earnings at the corporate tax rate. So, it could be a good idea in certain circumstances, but just watch out. The final type of trust is what we call a testamentary trust. And this is a special type of trust related to estate planning. It's a trust that is created on the death of another person so that their assets will fall into that trust and then operate similarly as a discretionary or family trust. Using a trust can have a number of benefits. I've listed them here, including asset protection. It can move assets out of individuals' names. The second one being tax options and increased flexibility. So remember the example, each year the trustee can make a choice about which members of your family receive the income or profits from the trust. And the final benefit is around estate planning, because if you structure these things correctly, should somebody pass away, the trust will just continue on very much in the same way as it did before they passed. Now I'm going to run you through a basic example that can show you how a trust can work. So imagine you've got a mum who's just received an inheritance of $2 million. You can invest that money, earn 5%, and that's going to make you income of about, $100K per year. Tax on $100K is about 25, and that's the scenario that's going to play out if the mum continues to hold the $2 million in her own name. What your mum can do, she can choose to set up a family trust over here and gift the $2 million into the trust. What this does, it builds a layer of asset protection because it moves the asset out of her name and into the name of the trust. So should something go wrong and the mum gets sued, it's built in that layer of asset protection. The second thing that can happen here is that we can get some tax options in relation to the 100K income. This money is just used for, ordinary family stuff, running of the households and things like that. So what can happen each year, the trustee over here can make a choice about which member of the family receives the $100,000 income. So if we go over here, 50% to mum and then 50% to dad, the tax payable on that would be 7.5K each, bringing a total of $15,000. And what they've been able to do by accessing the tax options available with a family trust, they could reduce their tax bill by $10,000 a year. Okay, in summary, what have we learned? A trust is from the ye old days in England when kings would go off and fight wars, and they would need somebody to delegate their legal authority to run the kingdom while they're away. What does that mean today? That we have someone who has a type of property, be it a farm or a business, that they want to delegate the legal authority to somebody else, the trustee, to deal with that property on behalf of the beneficiaries. Generally these days, that's the appointor's family. There's always a trust deed that has got the rule book, which explains how it all works. There's generally a few types of trust: discretionary trust and fixed trusts. And the benefits of operating a trust or using a trust are, of course, asset protection, tax options, and estate planning. I hope this video has helped you answer the question, what is a trust?